Trump's 25% tariff on Mexican and Canadian imports threatens North American trade and may hurt U.S. consumers more than it helps. In response, Mexico and other Latin American leaders are preparing countermeasures, challenging U.S. influence. Eagle Discovery will continue to follow this development and its impact on global trade. The context of USMCA and tariff decision. The USMCA, United States-Mexico-Canada Agreement, which replaced the North American Free Trade Agreement, NAFTA, officially took effect in 2020 after intense renegotiations led by the Trump administration during his first term. Trump had previously threatened to dissolve the agreement unless Mexico and Canada agreed to significant changes, particularly concerning automotive rules of origin, labor rights, agricultural trade, and dispute resolution mechanisms. The final agreement maintained the trilateral trade structure, but included stricter labor provisions and higher regional content requirements for vehicles, reflecting the U.S. administration's goal of reshoring production. Despite this structured agreement, Trump has now proposed imposing a 25% tariff on Mexican and Canadian products, citing concerns over undocumented migration and fentanyl trafficking into the U.S. These issues, while pressing, have no direct linkage to trade agreements, and leveraging tariffs as a means of diplomatic pressure undermines the principles of free trade and economic cooperation. This move signals a potential shift toward economic nationalism and protectionism, which could severely damage trust in the U.S. as a stable and reliable trade partner. Furthermore, such a drastic tariff hike risks sparking retaliatory measures from Mexico and Canada, further disrupting North American economic stability. Mexico's importance to the U.S. as a trading partner. Mexico has solidified its position as the United States' largest trading partner, surpassing both China and Canada. In 2023, total trade between the U.S. and Mexico exceeded $700 billion, highlighting the depth of economic interdependence between the two nations. This partnership extends beyond simple imports and exports. It is characterized by highly integrated supply chains in key industries such as automotive, electronics, aerospace, and agriculture. The automotive sector exemplifies this deep integration. Mexican factories not only produce finished vehicles for export to the U.S., but also manufacture essential components such as engines, transmissions, and electronic modules, which are then assembled in American plants. Some estimates suggest that as much as 40% of the value of a car manufactured in the U.S. is derived from Mexican-made parts. Imposing a 25% tariff on these goods would significantly increase production costs, reducing the competitiveness of U.S.-made vehicles in both domestic and global markets. Beyond manufacturing, Mexico plays a crucial role in the U.S. food supply. The country is a top exporter of fresh produce, including avocados, tomatoes, and berries, which are staples in American households. Any disruption to this supply due to increased tariffs could lead to higher food prices, disproportionately affecting low- and middle-income American families. Additionally, American farmers rely on exports to Mexico, particularly in the corn and meat sectors, and any trade retaliation could harm rural economies in the U.S. The impact of tariffs on the U.S. economy. While tariffs are often framed as a means to protect domestic industries, historical evidence suggests they tend to have adverse effects on the economy imposing them. The proposed 25% tariff on Mexican and Canadian imports could lead to significant disruptions in supply chains, increased production costs, and ultimately higher consumer prices. C. For U.S. manufacturers, these tariffs would mean either absorbing higher input costs, thus reducing profitability, or passing those costs on to consumers. Higher prices for vehicles, electronics, and household appliances would contribute to inflationary pressures, eroding purchasing power for American households. This could also complicate the Federal Reserve's ability to manage interest rates, potentially prolonging economic uncertainty. Furthermore, previous instances of aggressive tariff policies, such as the trade war with China during Trump's first term, resulted in retaliatory tariffs that hurt U.S. farmers and exporters. A similar response from Mexico and Canada could target key American industries such as agriculture, aerospace, and machinery, exacerbating economic strain on U.S. businesses that rely on international markets. In a broader geopolitical context, these tariffs could push Mexico and Canada to strengthen trade ties with other global partners, reducing their reliance on U.S. markets. Mexico, for instance, has been expanding trade relations with the European Union and China, seeking to diversify its economic dependencies. If U.S. protectionist measures persist, North American economic integration could weaken, ultimately making U.S. companies less competitive on the global stage. The international trust in the U.S. as a leader of free trade. A crucial factor in the evolving global trade landscape is the international community's trust in the United States as a leader in free trade and economic stability. For decades, Washington has positioned itself as a champion of open markets, advocating for globalization and trade liberalization, while pressuring other nations to dismantle protectionist policies. The U.S. played an instrumental role in shaping major international trade agreements, including NAFTA, 1994, and later the USMCA, 2020, reinforcing its reputation as a proponent of free and fair trade. However, recent protectionist measures taken by the White House have severely undermined this credibility. The imposition of unilateral tariffs, aggressive trade policies, and inconsistent regulatory decisions has signaled an unstable and unpredictable economic environment. This shift has shaken global confidence in the U.S. as a reliable trade partner, leading many nations and multinational corporations to reassess their economic dependencies. Key factors undermining U.S. trade credibility: unilateral tariffs and trade wars. The use of tariffs as a political tool, especially in disputes with allies like Mexico, Canada, and the European Union, has eroded trust in the U.S. commitment to free trade principles. Companies operating within integrated supply chains struggle to plan long-term investments due to the uncertainty of sudden policy shifts. Foreign investment deterrence: multinational corporations seek stable, transparent trade environments. The frequent shifts in U.S. trade policy discourage foreign direct investment, FDI, as businesses fear regulatory unpredictability. Countries like China and the European Union have increasingly positioned themselves as alternative investment destinations for companies looking for consistent trade policies. Contradictions in trade commitments. The shift towards protectionism contradicts decades of U.S. rhetoric promoting open markets and economic integration. Allies and trade partners question the reliability of American leadership, leading them to diversify their economic alliances and reduce dependence on U.S. markets. Impact on international supply chains: businesses that rely on cross-border trade and just-in-time manufacturing models are especially vulnerable to sudden tariff impositions and regulatory changes. This volatility disrupts supply chains, raises costs, and forces businesses to rethink their trade networks, potentially shifting away from U.S.-centric models. As global economic power becomes more multipolar, nations and businesses are increasingly looking beyond the U.S. to establish new trade partnerships. If Washington continues on a path of economic nationalism, it risks ceding leadership in global trade negotiations to China, the European Union, and regional trade blocs, which may be seen as more stable and predictable partners. Claudia Sheinbaum's response and Mexico's strategy. Since taking office, Mexican President Claudia Sheinbaum has pursued a pragmatic yet firm approach to trade tensions with the U.S., prioritizing economic diversification and reducing reliance on the U.S. market. Key trade strategies: expanding trade partnerships, strengthening ties with the EU, China, and Latin America, increasing foreign investment in high-tech sectors, and boosting participation in global trade agreements. Enhancing economic resilience, investing in infrastructure, innovation, and agriculture to improve competitiveness and reduce food dependency on U.S. imports. Retaliatory tariffs, targeting U.S. agricultural exports, corn, soybeans, chicken, to pressure key political sectors while advocating for fair trade policies. Mexico's diplomatic approach. While standing firm, Sheinbaum maintains open dialogue with the U.S., supports fair trade within USMCA, and strengthens global alliances to minimize future vulnerabilities. A shift in North American trade. If the U.S. persists with protectionist policies, Mexico's realignment with global trade partners could weaken Washington's economic influence, positioning Mexico as a more independent and resilient economic power. The importance of Mexico in global economic realignment. The current trade tensions with the U.S. present a pivotal moment for Mexico to redefine its role in the global economy. While these frictions pose immediate challenges, they also offer an opportunity for Mexico to strategically reposition itself, reducing its historical overdependence on the U.S. market and diversifying its economic partnerships. One of the most effective ways Mexico can capitalize on this situation is by expanding trade alliances beyond North America. The country is already a signatory to multiple international trade agreements, such as the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, and the European Union-Mexico Free Trade Agreement, which provide access to major global markets. Strengthening economic ties with the European Union, China, and fast-growing economies in Latin America and Asia could open up new trade routes, investment opportunities, and industrial collaborations. Beyond seeking new trade partners, Mexico must also invest in domestic infrastructure and industrial development to remain competitive. Key areas of focus should include enhancing transportation networks to facilitate efficient logistics and exports, modernizing industrial production to attract foreign direct investment, FDI, boosting technological innovation to position Mexico as a leader in manufacturing and supply chain resilience. Additionally, Mexico must diversify its export portfolio, reducing its dependency on U.S. demand for key products like automobiles, machinery, and agricultural goods. Strengthening food self-sufficiency and fostering advanced manufacturing sectors, such as electronics and renewable energy technologies, can help Mexico mitigate future risks from trade disputes. Historically, economic pressures from external powers have often fostered greater regional cooperation in Latin America. This moment could serve as a catalyst for deeper economic integration within the region, encouraging nations to form stronger trade blocs and collective agreements. Strengthened Latin American unity could increase bargaining power on the global stage, making the region less vulnerable to economic coercion from the U.S. or other major economies. In summary, rather than viewing the current trade tensions as purely detrimental, Mexico has an opportunity to leverage this shifting landscape to build a more independent, diversified, and resilient economy that is less reliant on U.S. policies. Internal contradictions in Trump's policy. While former President Trump has consistently promoted himself as a champion of economic nationalism, his trade policies expose deep contradictions within both the U.S. economy and political landscape. One of the biggest challenges is that many U.S. businesses strongly oppose disruptions to North American supply chains. Industries such as automotive manufacturing, technology, and consumer goods production depend on tightly integrated supply networks that stretch across the U.S., Mexico, and Canada. These companies rely on Mexico for cost-effective labor and production facilities, and any tariff increases or trade barriers could result in higher production costs, which would be passed on to U.S. consumers in the form of price hikes. Job losses in industries that depend on Mexican and Canadian imports for raw materials and components. Reduced competitiveness of American firms in the global marketplace, as companies struggle with disrupted supply chains. Similarly, U.S. agricultural producers are deeply concerned about losing access to key export markets. Mexico and Canada are two of the largest buyers of American agricultural products, particularly corn, soybeans, beef, and dairy. Farmers, especially in Midwestern states, rely on these exports to sustain their livelihoods. Any retaliatory tariffs from Mexico or Canada could severely impact rural economies, potentially causing economic instability in regions that form a crucial part of Trump's voter base. Another major contradiction in Trump's economic nationalism is its conflict with the core principles of the Republican Party. Traditionally, Republican economic policy has favored free markets, deregulation, and open trade. However, Trump's protectionist approach contradicts this stance by prioritizing tariffs, trade restrictions, and government intervention in commerce. While his America First rhetoric resonates with certain voter segments, it clashes with long-standing conservative economic ideology, creating ideological divisions within the Republican Party. These internal contradictions complicate efforts to implement a clear, cohesive trade strategy. On one hand, Trump's base includes manufacturing workers who favor protectionist policies to bring jobs back to the U.S. On the other hand, business leaders, farmers, and free market Republicans strongly oppose trade restrictions that disrupt their industries. This tension within the party raises concerns about whether Trump's policies are sustainable in the long term or if they risk alienating key economic and political stakeholders. Ultimately, the ongoing trade disputes highlight broader systemic challenges in America's approach to global commerce. While Mexico must navigate these complexities, its ability to assert economic sovereignty, build new alliances, and adapt to shifting trade dynamics will be crucial in shaping its future economic trajectory. The 25% tariffs on Mexico and Canada threaten the U.S. economy by disrupting supply chains and weakening global competitiveness. While Trump frames it as a political win, North American trade integration has benefited all parties for decades. Mexico, under Claudia Sheinbaum, has rejected tariff extortion and shown its ability to respond. This situation may also encourage Latin American countries to strengthen regional cooperation and resist U.S. pressure.